Hello everyone and welcome to the Rosecut November update. It's been a busy couple of weeks as usual in markets. We had some positive news out last week with the US inflation numbers coming in a bit below expected, which has really kicked off a rally over the last week. And that's lifted spirits despite some of us coming down with colds and the weather turning down. Mike, good of you to join us as ever. What did you make of last week's action?
Yeah, hi Dan. And I am a bit croaky. The November weather's kind of got to me, but so we're in this kind of curious environment where I think you have to appreciate how markets behave. In that we've had two inflation readings, CPI and PPI, consumer producer prices, both of which have come in slightly less than expected, but still at very, very high levels. So CPI, for example, in the US, the rate of change year on year is 7.7%, which historically, certainly for the last 30, 40 years, is enormous and is causing lots of stress and lots of trouble in economies. But it came a little bit less than expected and led markets to believe, I guess, that inflation has peaked and will now come down from here. I think the jury is still a bit out on that. The market move was enormous. So the S&P in the US rallied nearly 6%, which historically is a huge kind of move. The only previous times we've seen moves like that have really been in the context of economic or financial market crisis, when, for example, you get a change in policy making. So quite a big move there. And that just shows you how sensitive the market is to inflation and where inflation goes. And I think this is going to be a big story into next year. One lingering concern I have is that, a lot of commodity prices are kind of stable at high levels. Some marginal drivers of inflation, from used car prices to lumber, have come right down. But inflation is quite sticky. Wages beginning to rise, service inflation is quite high. So that is all a concern as we head into next year.
Yes, I think the conversation will change now from when does inflation peak to how quickly does it come back down to the 2% level that policymakers desire. But as you're saying, in the last week, equity markets have risen on the back of the inflation number. Something else that's done well is the government bond market. So those have rallied as yields have come down. And also the dollar's weakened, which has taken some of the pressure off parts of the world which had their currencies really suffering. It really caught out some of the hedge funds though, I think. So a lot of the names that hedge funds were short, i.e. they're expecting share prices to fall. They've rallied quite a lot, and we call that a short covering rally. I think we've mentioned it a couple of times
we've
had these bear market rallies. It's quite illustrative to look at the biggest stock in the US market though, which is Apple, which you were mentioning before we started recording, I think is now worth as much as Amazon, Tesla, and what's the third one in there, Mike?
I think Amazon, Tesla, and maybe Google. People talked about the FANG stocks, the big tech stocks. And what we've seen is the previously gargantuan tech stocks like Meta, the old Facebook, Amazon, both of those really taken down a peg or two or three. I mean, they've halved, I think, in the last 6 months. And that speaks a lot to how people are changing the way they use technology, and also to how the consumer is. But Apple has remained pretty strong and pretty well bid. I think what's at the back of my mind as we get into next year is, will Apple just maintain its strengths? The new iPhone, the iPhone 14, hasn't been selling as robustly as perhaps other new issues have in the past. And maybe some fund managers now begin to kind of do a value growth trade in tech, which is buy some of the cheap tech stocks that are really, knocked down, like Meta maybe, and out of Apple. So that's a big trade to watch for next year.
Yes, I get the sense that a lot of fund managers who have to hold so much in equities have already hidden as much in cash as they can, so they've had to hide somewhere else as well. And I suspect Apple is one of those stocks that's benefited, because certainly when I look at it, some of the valuation metrics, I think Wall Street expects it to earn just a bit over $6 next year.
Yep.
And they're putting a 24 times multiple on that. For those that aren't familiar with this terminology, if you take the share price and divide it by its earnings, you get a price to earnings ratio, and that's a measure of how cheap or how expensive a stock is. And pre-COVID, it would trade between 16 and 18 times. And now it's at about 24 times. So there's plenty of scope for Apple to re-rate a bit lower.
Yeah.
It's just the catalyst for that. Turning back to the rest of the world, China reopening is one of the stories that people are looking for, because this would spur a lot of demand for commodities, among other things. And the jury's still out, I think, on what China's going to do in terms of reopening. They seem to be making steps towards it and lifting some of the COVID lockdowns, but it's not fully reopened yet.
What is unusual in China is that there's beginning to be political opposition to the tough COVID stance, and even some cases of rioting, which suggest that socially and politically, China's probably reached the limit of the COVID policy. And we've already seen a couple of big day rallies in the Hong Kong exchange on the back of this. If this happens, it's probably a broad positive for the world economy. Not a great positive if you're a Western central banker worried about inflation, because it's a sort of a stimulus, if you like. And if you think about how the Western economies reacted when they came out of the COVID lockdown, and you have the same in China, then that produces kind of a boost to the world economy, which probably means that rates will be higher for the rest of this year, or next year rather.
Yes, so China reopening would bring more demand back, whilst the Western central banks are currently trying to raise interest rates to create demand destruction. That's what you're saying, I think.
Exactly, yeah.
And the other piece of news we saw recently was US midterms. So the Republicans did not quite as well as expected. I think they've got the House but not the Senate, so that could create a few issues for President Biden going forward in terms of trying to get changes through. And the final story that I think we'll end with this time is crypto. We haven't spoken about crypto for a while because it's at that stage of its particular cycle where things are, how can I put it, going wrong, or fraudsters are being cleared out of the system. It seems to happen every 4 years. I know crypto's not been around a long time, but there's a pattern there.
Yeah, that's true. So I think this is where my love of financial history kicks in, because anyone who has seen financial innovation in the past, it tends to operate like this. You get these big bubbles in prices, they correct, and then the infrastructure in the industry really gets sorted out. I do think that, looking at it from afar, what's happened with that FTX seems to be a case of extremely bad governance and borderline fraud. And that's kind of collapsed the house of cards, across exchanges. And it is ironic because many of the people in the crypto industry, they disavow the whole idea of a centralized financial system and regulation and control by central banks. To the extent that anyone who invests in the stuff or who trades with these exchanges, you're very much on your own. You have no recourse in many of the normal areas of kind of financial law. Two things are going to happen. I think the crypto exchanges are going to come under a lot of pressure. I think there will be pressure for the exchanges, maybe not Bitcoin and other coins to be regulated, but the exchanges would be more tightly regulated. And I think the next trend would be digital assets infrastructure. And we're seeing that already. I mean, last week, the New York Fed has started an experiment with the 12 big banks in the States to basically start to trial digital coins. So that whole area, I think, is still going to grow. Yeah, absolutely. I think the issue of regulating the exchanges is a very sensible one, because in terms of how do you guard against money laundering and bad actors in the crypto space, I think the only way you can do it is by regulating the, as they call it, the off-ramps. So when you're converting from crypto back into dollars or pounds, etc., that's when the regulation can really kick in and be effective. In the meantime, I think anyone who's got money left on exchanges, I'd be very careful there. I think so far we've had FTX as the big one recently. That's, as you mentioned, gone under. I've seen also BlockFi, Genesis, I think yesterday. Some of these I'd not heard of before, to be honest, but they're pausing for withdrawals or indeed going into liquidation. Two things to watch for, I think, in the crypto space. One is MicroStrategy, the company that added Bitcoin to its balance sheet with leverage.
And the second one is Tether, the stable coin where if it turned out to be fraud, it would be the least surprising news story I've ever read. So I would keep an eye out for those as well.
Yeah, exactly.
In the meantime, our portfolios, of course, they don't have any crypto in there, so this is more just general financial news. Our portfolios remain defensively positioned, less volatile than the market, they're holding up. We'll see what the next month brings. And I look forward to speaking to you again in December.
Yes, very much so. Yeah.